Why borrowers choose Mutuum for over-collateralized loans? Everything shared on this video is only for educational purposes. Mutuum gives a unique opportunity to borrowers. You can access to liquidity without selling any of your assets. With Mutuum, you can have competitive interest rates based on the pool's utilization. Now, the way that Mutuum works is that it's a decentralized non-custodial liquidity pool, which enables users to interact as lenders, borrowers, or liquidators. And the unique mechanism of Mutuum is that it gives you interest if you're a lender, and if you're a borrower, you can obtain over-collateralized loans by securing them with sufficient collateral. Now, Mutuum uses two models, the peer-to-contract model and the peer-to-peer model. With those unique models, you have the option as a borrower to choose between a variable interest rate on the loan you take or a stable interest rate. As a decentralized protocol, Mutuum gives the feature of transparency because of the on-chain loan terms. And you can borrow with confidence on a secure protocol. With Mutuum, you have the option of multiple asset types that are accepted as collateral. They call it multi-asset collateralization. In many traditional decentralized systems, minting and decentralized stablecoin involves single asset vaults, where each collateral type is siloed in a separate position. Now, Mutuum envisions a multi-collateral approach, allowing users to deposit various supported assets into the protocol and mint its stablecoin from a consolidated pool of collaterals. With the unique way that Mutuum's lending model works, you have an easy loan repayment model and different options. You also have the ability of flexible borrowing terms, and they have an active community and support 24/7. Now, you may be wondering why borrow from Mutuum compared to other protocols. The reason is because of their interest rate mechanism. The borrow interest rate is derived from the utilization rate, which indicates how much capital is actively being borrowed compared to the total pool supply. Now, this rate model helps Mutuum balance liquidity through incentives. Now, when the capital is abundant, so when there are a lot of money inside the pool, interest rates go down and they remain comparatively low. That way encourages borrowers to take loans and put idle assets to use. Now, when the capital is scarce, interest rates go up to motivate loan repayments, that way reducing outstanding debt, and it attracts also additional deposits from potential lenders seeking higher yield. So you as a borrower, if there is a lot of liquidity into the pool, it's attractive because you get lower interest rate. Now, let's say that liquidity gets scarce in the pool. Yes, interest rates go up, but this attracts lenders that they are willing to put their liquidity into the pool, so you can borrow even higher loans and remain the rates lower. So if you're a person that's looking to borrow crypto in order to invest them, and you're looking for a decentralized way with flexible and low interest rates and a secure way and protocol to do so, Mutuum is for you. Click the link below and read everything on how you can become a borrower in the protocol. Thank you so much for being until the end of the video. That's all for now. Don't forget to click the like button and also the subscribe button so you don't miss any of our future videos, which will help you in your cryptocurrencies journey. That's all for now. Thank you so much.